Get ready to unlock the secrets of trading success in this electrifying episode of the Optimus Futures podcast, Everything Futures. Today, we're diving deep into a crucial, often overlooked aspect of trading, capital preservation. Forget the short-lived thrill of immediate gains. It's time to learn from the top 1% of ultra-successful traders who know mastering capital preservation is the key to long-term day trading success. This episode is packed with expert insights and strategies to help you refocus and develop the essential skills for safeguarding your capital. Plus, make sure to take advantage of an exclusive exploration of our cutting-edge platform, Optimus Flow. Visit optimusfutures.com for a transformative trading experience. Tune in now and start your journey towards trading mastery. Capital preservation versus profit chasing. The core difference: capital preservation refers to strategies and practices used to maintain and safeguard a trader's initial capital in the high-stakes world of day trading. It involves making strategic decisions to prioritize the long-term safety of one's investment over short-term gains rather than merely avoiding losses. Day traders must conduct a meticulous risk assessment for each trade, ensuring that any potential loss is manageable and does not jeopardize their overall trading account. Capital preservation is crucial for long-term success in trading, as day trading involves frequent transactions and the market's volatility presents significant risks. A profit-first approach, or chasing immediate profits, is dangerous and akin to running before learning to walk in the trading world. This mentality can lead to high-risk behaviors where traders overlook crucial risk management principles driven by the allure of quick gains. Over-leveraging and over-trading are common pitfalls in trading that occur as a result of profit chasing. Over-leveraging involves using excessive margins to finance trades, aiming for larger wins. While this can amplify profits, it equally amplifies losses, potentially leading to rapid capital depletion. Overtrading, another byproduct of profit chasing, involves making excessive trades without proper strategy, often driven by emotion rather than careful analysis. This behavior increases transaction costs and exposure to market volatility, both of which can erode capital quickly. Prioritizing capital preservation aligns with a more sustainable and strategic approach to trading. This methodology emphasizes the importance of staying in the game by focusing on protecting capital. By preserving capital, traders ensure they have enough resources to continue trading and learning from the market. This approach cultivates a disciplined mindset, leading traders to make more calculated and informed decisions. Capital preservation strategies involve setting strict stop-loss orders to limit potential losses, sizing positions appropriately to manage risk, and diversifying trades to spread exposure. These practices collectively contribute to a more balanced trading portfolio, reducing the likelihood of substantial losses from any single trade. Moreover, a focus on capital preservation encourages continuous learning and adaptation. By preserving capital, traders can experiment with different strategies, analyze their performance, and refine their approach based on actual market experience. This iterative learning process is invaluable in developing the skills and intuition necessary for successful trading. In essence, prioritizing capital preservation over immediate profits sets the foundation for a more sustainable, disciplined, and ultimately profitable trading career. It's about making prudent decisions that ensure longevity in the market, providing the opportunity to leverage experience and knowledge for future success. Survival is the key objective for novice traders who enter the unpredictable world of day trading. The focus should be on learning and adapting to the market, rather than immediate profit accumulation. In the early stages of a trading career, survival is critical, and it is more important to develop knowledge and skills than to earn profits. The foundation for success in trading lies in the ability to survive in the market. Surviving in trading means much more than financial endurance. It involves mastering the art of staying in the game, preserving capital, and developing a deep understanding of market dynamics, trading techniques, and personal risk tolerance. Beginners should not be judged by the profits they make. Instead, their progress should be measured by the knowledge they acquire and their ability to apply it effectively. By focusing on survival, traders ensure they have enough capital to continue trading, learning, and refining their strategies. This approach prevents the common pitfall of blowing up an account due to aggressive or uninformed trading practices. Resilience is another essential aspect of survival in trading. Even seasoned traders face losses, and beginners should view early losses as tuition fees for the market's invaluable lessons. Resilience is the ability to take a hit and come back stronger. It involves learning from losses and developing strategies to mitigate future risks. Emotional discipline is also critical for survival in trading. The market can be an emotional roller coaster, and how a beginner navigates these emotions can set the tone for their future in trading. One must learn to stay calm and objective, making decisions based on logic and analysis rather than fear or greed. Emotional discipline also involves knowing when to step back and wait for the right opportunities. The importance of survival in early trading cannot be overstated. Focusing on acquiring knowledge, preserving capital, building resilience, learning from losses, and developing emotional discipline is vital. By mastering these skills, traders can increase their chances of long-term success in the volatile world of futures trading. How can you trade to preserve your capital instead of focusing on making gains? 1. Implement strict risk management techniques. The most effective way to preserve capital is to have a robust risk management strategy. This includes setting strict stop-loss orders on each trade, which automatically exit a position at a predetermined level to prevent significant losses. Additionally, traders should employ position sizing to ensure that no single trade risks more than a small percentage, usually 1-2% of their total trading capital. 2. Focus on high-probability trades over high-reward trades. Instead of chasing trades with the potential for high returns, prioritize trades with a higher probability of success, even if the profit margin seems smaller. This approach involves thorough market analysis and choosing trades aligned with your tested trading strategies. High-probability trades are generally more consistent and can contribute to steady capital growth. 3. Transition between different futures contracts for risk management. In the futures market, different contracts have varying levels of volatility and risk profiles. To preserve capital, be flexible in moving between different futures contracts based on current market conditions and volatility. For instance, if the micro S&P futures market becomes too volatile for your trading method, shifting your focus to micro NASDAQ futures or another less volatile contract could be a prudent move. This strategy involves continuously assessing the market environment and choosing contracts that align with your risk tolerance and trading style. By shifting between futures contracts in response to changing market conditions, you can better manage risk and protect your capital. 4. Avoid over-leveraging. Leverage can amplify gains, but it also magnifies losses. To preserve capital, use leverage sparingly. If you choose to use leverage, ensure it's within manageable limits and that you fully understand the risks involved. Over-leveraging is one of the primary reasons many traders face significant capital depletion. 5. Adopt a long-term perspective and patience. Short-term market fluctuations can be tempting for quick gains, but they are also riskier. Adopting a long-term perspective helps in making more informed and less impulsive trading decisions. Be patient and wait for the right trading opportunities that align with your strategy and risk tolerance. This approach helps in avoiding the trap of overtrading, which can erode capital through fees and less thought-out trades. In the world of trading, the ultimate goal is to generate profits. However, the best way to achieve this is by focusing on preserving capital and implementing effective risk management strategies. This approach may seem counterintuitive, but it is founded on the principle that long-term success in trading is not about making high-risk bets, but about consistently applying practices that safeguard your trading capital from significant losses. Prioritizing capital preservation shifts your trading strategy from a high-risk, gain-seeking approach to a more sustainable, risk-averse methodology. This philosophy is based on strict risk management techniques, such as setting predetermined stop-loss orders and adhering to prudent position sizing. These practices create a safety net that prevents any single trade from disproportionately affecting your overall capital. By minimizing the potential damage from unsuccessful trades, you also instill discipline into your trading decisions, ensuring that they are guided by logic and strategy rather than emotion and impulsiveness. Similarly, focusing on high-probability trades reinforces the concept of cautious trading. Choosing trades wisely and engaging in trades where the odds are more in your favor enhances the possibility of consistent gains over time. In the dynamic environment of the futures market, flexibility in shifting between different contracts is another key aspect of capital preservation. This agility allows you to adapt to varying levels of market volatility and risk, aligning your trading actions with the most favorable market conditions. By moving from one contract to another as market volatility dictates, you demonstrate a responsive approach that prioritizes the stability of your capital over the uncertain prospects of market speculation. Moreover, the underlying thread that connects all these strategies is the long-term perspective and the virtue of patience. Trading is not a sprint to quick riches, but a marathon that demands persistence, learning, and adaptation. By adopting a long-term view and exercising patience, you allow your strategies to mature and bear fruit, steering clear of the pitfalls of overtrading and emotional decision-making. In conclusion, the journey to profitability in trading is intricately linked to the principles of capital preservation and risk management. It demands discipline, strategic planning, and an unwavering commitment to protecting your investments. Pursuing profits in the trading world is often most effectively realized not by chasing gains directly, but by consistently applying practices that safeguard your capital. This approach ensures not only the survival and stability of your trading endeavors, but also sets the foundation for sustained growth and success. Ultimately, making money in trading is a result, a byproduct of a steadfast commitment to preserving capital and managing risks with diligence and foresight. Thanks for tuning in to another episode of Optimus Futures Podcast, Everything Futures. We hope you found this episode informative and enjoyable. We highly recommend subscribing to our podcast to stay updated on the latest day trading and futures trading tips for beginners. Please visit our website, optimusfutures.com, for more information. Don't forget to give us a thumbs up if you liked this episode. This material should be viewed as a solicitation for entering into a derivatives transaction. Trading futures and options involves substantial risk of loss and is not suitable for all investors. Past performance is not necessarily indicative of future results. The risk of loss in trading commodity interests can be substantial. You should therefore carefully consider whether such trading is suitable for you in light of your financial condition. The placement of contingent orders by you or broker or trading advisor, such as a stop loss or stop limit order, will not necessarily limit your losses to the intended amounts, since market conditions may make it impossible to execute such orders. The high degree of leverage that is often obtainable in commodity interest trading can work against you as well as for you. The use of leverage can lead to large losses as well as gains. Optimus Futures, LLC is not affiliated with, nor does it endorse any trading system, methodologies, newsletter, or other similar service. We urge you to conduct your own due diligence,